Good day and welcome to the Mahindra CIE Q1 FY20 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishant Vaz from ICICI Securities. Thank you and over to you, sir.
Thanks a lot. Good day everyone and thanks for joining us today for the call. From the management side, we are represented by Mr. Rander Alvarez, the CEO, Mr. K. Jayaprakash, the CFO, Mr. Vikas Sinha, Senior Vice President Strategy, and Mr. Alois Lafont, the Business Controller. Now I would like to hand over the call to the management for your initial remarks. Over to you, sir.
Yeah, thanks. This is Vikas. Thanks, Nishant. Good afternoon, everyone. I welcome all of you on this call, as also Anders Aranatha, CEO. Thank you for being with us in these trying times of the COVID crisis. I hope and wish that all your loved ones are taking care and are safe. Before we start with the results, let me take this opportunity to state that COVID is a global humanitarian crisis before anything else. CIE salutes the frontline health workers, policemen, and other workers who are risking themselves every day to keep our life moving when many of us are locked down at home. Let us now start with the MCI results for the first quarter of CY20. We will start with some background on MCI, and I am referring to the presentation that we uploaded yesterday, with the legal structure on page 5 and some highlights of Q1 T20 on page 6. Significant among the highlights is the fact that CIE has reinforced, our parent CIE Automotive of Spain has reinforced faith in MCIE by acquiring an additional 121,000 shares of MCIE from the open market in the last week of Q1 T20. Results for our India business for Q1 T20 are on page 8. We have managed to keep the EBITDA at 13%, which is an improvement over Q4 T19 despite the sales being lower. So sequentially, sales have come down, but margins are up. The last fortnight of March was affected badly by the COVID crisis, which has lowered sales in Q1 T20. The EBT is 16 million rupees in this quarter, but this includes 413 million rupees of negative exchange rate fluctuation associated with the BF Mexico USD loan of 26 million USD. This is a mark-to-market and is an exceptional item. Our European results for Q1 T20 are shown on page 9. The sales dropped substantially compared to Q1 T19 on account of the double impact of the drop in demand due to COVID-19 and the slowdown in the market for our gears Italy business. Due to these two effects, the EBITDA has fallen to 10.5%. Labor adjustment measures have already been taken in this quarter and they will provide a cushion in the coming quarters. And now if we go to slide 10, we will see the consolidated results, which are a combination of the evolution in both India and Europe. Despite a difficult market situation worldwide, our EBITDA is at 11.7 in Q1 T20. In absolute terms, EBITDA is 37% lower compared to Q1 T19, which if you recall was one of the best quarters MCIE has had. I would like to mention again that EBT is at 455 billion and includes 413 million Indian rupees in terms of the exceptional item of negative exchange rate fluctuation due to the BF Mexico USD loan. Slides 13 and 14 talk about the market forecasts in India and Europe from different research companies. We would, however, like to emphasize that the real-life situation is very fluid and evolving rapidly. Therefore, any market forecast can be taken as a general trend, but these could change rapidly based on how the pandemic pans out. In general, all agencies are forecasting substantial drop in demand in all segments, both in India and Europe. April sales will be close to zero in India and much lower than normal in Europe. Our German and Italian plants have currently restarted and our Spanish plants at next week. But May and June sales are still uncertain. Expect potential recovery in Q3 T20 in India and Q4 T20 in Europe. The uncertainty is caused by the fact that the consumer would be careful about discretionary spend as household balance sheets get battered by the lockdown. Let us turn to pages 16 to 18. We have elaborated our response to the COVID crisis. Let me reiterate again, we are treating it as a humanitarian crisis first and foremost. At this time, MCIE has started with providing masks and sanitizers to all employees and periodic sanitization of workspaces when operations were continuing pre-lockdown. Manufacturing operations across all MCIE plants in India are currently shut down as per local government directive. MCIE is committed to all stakeholders during this time, including contract and temporary workers and suppliers. We are following all the government directives regarding all these stakeholders. Due to the prolonged nature of the COVID crisis and the fact that the lockdown seems to be the only available antidote, it is a huge economic crisis as well. This is an unprecedented situation where both the demand and supply sides are affected. The demand situation is especially challenging during these uncertain times. Q1 T20 saw some demand slowdown, but that could pale in comparison to what we might see in Q2 T20, as we have talked about earlier. Despite this situation, we are confident that MCIE will come out of this in a relatively better position. We have already put in place robust guidelines and systems in place for the structured restart of operations and subsequent stabilization once the lockdown ends. We have been completely focused on managing this complex situation. There is a weekly review of the cash flows. Teams are also working with customers to understand demand and delivery scenarios. CapEx is being reviewed and only the most urgent and important will be approved. Inventory is being drawn down. Outsourced activities are being reviewed for insourcing. Overtime is being curtailed. All heads of cost, including labor costs, are being reviewed closely. Here I might mention that European governments are applying aid schemes to our plants in Europe to help reduce our European labor costs to the tune of euro 3 to 4 million in Q2 T20. Let us remember that auto industry is an important constituent of the European economy and European governments will continue to have an eye on its well-being. It is worth pointing out that we have already embarked on a journey of operational improvement in both India and Europe pre-COVID in the last few months. We have been able to improve the EBITDA percentage in India in Q1 T20 compared sequentially to Q4 T19 in spite of a drop in revenue as pointed out earlier. Similarly, the truck and off-road markets in Europe have faced a massive drop in volume and we have been able to manage this drop without a large hit on our European margins. The post-lockdown measures will draw upon these projects. MCIE's cash position is secure and it has unused working capital limits to be comfortable even if current lockdown is further extended over a much longer period or demand recovery is much slower than even what the worst case scenarios are envisaged. MCIE has a solid debt position, enough headroom to pay debt and raise debt if required. MCIE's parent CIE Automotive of Spain is a global MNC and has a robust system of managing cash across its worldwide businesses. It is willing and able to help MCIE in the event of any liquidity requirement. CIE has reinforced its faith in the company and recently bought MCIE shares in the open market in late March, as pointed out earlier. CIE itself is also secure from a financial point of view. So we do not foresee any problems on that score. We believe that MCIE is in a secure position to not only manage this crisis and its fallout, but we are quietly optimistic that we will emerge stronger when the crisis blows over. Thank you very much. Now we can proceed to the Q&A.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Priyaranjan from Antique Stock Broking. Please go ahead.
Yeah, thanks, sir. I mean, good performance in difficult times. But how do you foresee in terms of what kind of guidance you are getting from the OEMs in Europe side and in India? That is the first question. And second question is on the kind of support you are getting from the wage support, etc. in Europe. Can you just throw some light?
And the first question is, what are the OEMs saying both in India and Europe on the market situation? And second question is about the support that the European governments are giving on the labor front.
Yeah, okay. Regarding OEMs information, that what we are getting right now, let's say that most of the OEMs are planning to resume production beginning of May. Okay, some of them they are planning to start slowly next week, 27th of April, and even, for example, some of them like Daimler or Renault, they have already started, but at a very low rate. And next week they will continue the ramp up, and our expectation is that most of them will be running in the first week of May, starting 4th of May or 11th of May, in that range. Okay, so what we see is the ramp up will start beginning in May, and we hope that by the end of May the production will be stabilized. Okay, and in India we also expect that the beginning of May, once the lockdown is finished, we will start the production ramping up step by step. Okay, so yes, we see a very weak April, and we will see a ramp up in May, and in June we will see what the market says. It is important to say that the uncertainty is very high in this moment, but our view is optimistic. We think that the Q3 in India will be we will see the market revamping, and in Europe probably will be a little bit later by Q4. And regarding the support from the government, it is in Europe, it's a little bit different. We have different programs in each country, but in Italy, for example, we have a program called Cassa Integrazione, and the government is paying approximately in Italy 80% of the labor cost, while the company is in lockdown. And in Germany, the programs that the German government is applying pays approximately 70% of the total cost of the labor. Okay. In Spain, it's a little bit less. In Spain, the payment is approximately 35 to 40%. Okay, that's the support that the governments are giving us in Europe.
Okay. And given the circumstances, do you foresee some kind of, EBIT or EBITDA loss in the first quarter? Because 1 month will be completely out of
Q2. You're talking about Q2. Let's talk in calendar year. Correct.
Yeah.
So in Q2, do you foresee kind of EBITDA loss in overall scheme of thing? And if you, if whatever cost program, etc. you have, so at what level of top line or operation do you think that your cash or EBITDA break even might happen?
Okay. Let's say the situation for the Q2, it will be tough for all the markets, especially because the sales on April will be, as Vikas said, close to zero in April in India, and something like 30% of the normal month in Europe, 25% of the normal month. So we will be affected for that, and the EBITDA margins, of course, will be affected. But what we think is that after April, in May, and in June we will start recuperating our standard margins. As you saw in the presentation, in India, despite the drop that we had, the sequential margin, EBITDA margin has improved in this first quarter calendar year 2020. This is mainly because we were doing we continue applying our efficiency improvement plans in all the technologies in our Indian divisions, and I think we were performing very, very well. Now, yes, we will be affected in the second quarter. It is very difficult for us to say how much we will be affected, but what I can say is that by the Q3 we will come back to the normal situation. We continue doing our works. In Europe, we will have the government support. In India, I think that the market will revamp a little bit faster than in Europe. That will help us. And as we are in a very strong and solid cash position, we will, of course, survive, and we expect to finish all this process, and we want to use all these unfortunate times to improve our management systems, to improve our internal efficiencies, and to finish all this process in a very reinforced situation, and be, as Vikas said at the end of the presentation, we want to be in a stronger position to cope with the market at the end of this year. Okay, so the impact, of course, we will have this impact. It's difficult to say how much which kind of drop we will have in the Q2. You saw that in the first Q, with this important drop of 30% approximately in Europe, and let's say without Aurangabad electrical, we dropped approximately another 30% in India also. So you saw that we only lost 1% EBITDA. So yes, we will lose something, but we will continue in a positive range in the Q2.
Okay, thanks. Nice to hear that. And just lastly say two things. One is on how do you see yourself after this COVID situation? Because I think if this persists, and because what we are thinking is that probably for next couple of quarters, the utilization level at many tier of vendors, etc., will be lower. So some of the smaller tier vendors, etc., might face problem in terms of liquidity and all. So do you foresee as strengthening yourself in terms of market share? And secondly, on any opportunistic acquisition target you can think of in this time?
Yes. Yes, I think that in this situation, the market will tend to consolidate the business in the stronger partners. Okay, so in this case, we hope to be in the winner list. This is what everybody expects, and what we expect also is to consolidate and to increase our market share in this situation. Regarding the opportunities, the acquisition opportunities, of course we are open to acquire companies, and if the target company meets our requirements and is aligned with our strategy, yes, we will go for those companies. Okay, so we are open. We continue working. I think this is important. Let's say that this drop in the market and this virus pandemic is a terrible thing, but we don't see let's say that we have an optimistic view of the future. So we are only thinking on the day after and reinforcing and continue our strategy as with the business as usual.
But Priyaranjan, before we move on, I think let's point out that our first focus area is to get our plants back and running and improve our position with our customers. M&A will be a second option, not the first.
Yes, yeah, of course, yes.
And sir, lastly, one thing, just on general global thing, which is, there has been a lot of talk of, say, local to local manufacturing, supply chain moving away from China. So, even Japan government has given some kind of incentive to move out manufacturing from China. So, any sense you are getting this is happening? Or some companies are trying to do that or even evaluating this?
Yeah. I would say this is right now. We have seen some movements from in some divisions. For example, in the magnet division, we clearly see this trend. However, I think it's too early to say that for the rest of the divisions. But you are right that probably this movement from China to India could happen because, in my opinion, the logistic chains, the supply chain in our industry will be reviewed deeply in the next times. Okay, so yes, we see an opportunity there that some of the Chinese production can move to India. In certain divisions, it's already happening, but it's too early. I think we need some more time to see the real effect of this pandemic.
Okay. And thank you. That's all from my side. One last thing, from JP, if it is there. So, what is the net debt level and what is the cash generation has happened in the first quarter?
Our debt level has remained at the same as of 31st December 19. Essentially, some committed capital expenditure we had to go through, so the debt has remained the same.
Okay, thank you.
Thank you very much. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much for the opportunity and best wishes for overcoming this COVID crisis. Just trying to understand, while you talked about customer plants getting ready to open in May, do you have some insight into what kind of production levels are they targeting?
Vikas, can you help me with the question?
No, the question, Mr. Puneet Gulati from HSBC, so he is asking that, yes, we have talked about OEMs restarting their operations from April end and May, but what kind of production levels, compared to a normal month, how much are they targeting in May?
Yeah.
That's the question.
Okay, in May, it's very difficult to say because there is a big uncertainty yet, and the customers, and this is why it is difficult to answer because the customers are changing their plans every week. Okay, my expectation can be around in May the market can be at a rate of between 40 to 50% of the normal month.
Okay. And do you foresee any your supply chain related issues to emerge when you start production, or is that largely on track?
We don't foresee any problem on the supply chain. No, we have been managing that, and we have created our stocks, and no problem. Till now, there is no issue.
And your vendors are all geared to start as you start as well?
Yes, we they are ready, and we are ready also. In fact, we are willing to start as soon as possible. And in fact, in India, we got some clearances from the government for certain plants, and we have already started some production in just 1-2 plants.
Okay, that's nice.
So that's in Rajkot. The gears plant in Rajkot is operating at some low level, and we produce some medical equipment at our composite plants at Mangaon, so that is allowed because it is medical equipment.
Okay.
Yes. And also Aurangabad electricals for some export production we have started also.
Aurangabad plant.
Yeah, Aurangabad plant, aluminum, high pressure vehicles.
Yeah. Okay. That's great. That's all from my side. Thank you so much and all the best.
Thank you very much.
Thank you. The next question is from the line of Jayesh Gandhi from Birla Sun Life Mutual Fund. Please go ahead.
Yeah. Good afternoon, gentlemen. Thank you for the opportunity. Couple of questions for you, Ender. In Europe and also in India, there were a few plants that we had which were not as optimal in terms of profitability as we would have liked them to be. What opportunity do we have now to shut those capacities or restructure them so that when we restart, all our plants are in good shape and profitable?
Yeah. Okay. We are managing this situation continuously. Okay, so this is our main job. I mean, manage the capacities, produce with efficiency, and make this business profitable in the long term. Okay, and we have been working on that, and that's why we have been restructuring our business especially in Germany. As you know, that this is our most complicated business. We have been restructuring the business, and despite the huge drop that we had in this Q, we were able to manage the EBITDA levels at the same level that we had in 2019. Okay, so yes, you can see that we are doing this restructuring. In India also we are doing also the job, and we are making all our plans. We think that India will perform well or very well, because we were seeing already the results in January, February. Then in March we saw the drop, but January, February we had a very good trend, and I think that when the market comes again, Q3, Q4, you will see a good performance and good evolution in India also. So in Europe we continue our plan. We are not changing the plan because of this crisis, because we have already that plan. So we are doing the restructuring, we are optimizing the businesses, and in both regions we are doing the job.
Wonderful. Good to hear that. My second question is more general in nature, in the sense that on the other side of the crisis, say 6 months or 1 year out, do you expect same level of automobile production, in the sense commercial vehicles or passenger vehicles, to happen? Yeah. Or is there now a realization that the world was producing just too many cars and commercial vehicles, and the production is going to be much lower, and hence there should be some destruction or reduction of capacity, and we will also have to do that?
Yeah. Okay. I think we will recuperate, and the recuperation will be different in the different sectors. Okay. Passenger vehicles, probably they will not come back in 2021. They will not come back to 2019 figures. Probably it will take 1 or 2 years to come back to that situation. So we will see the drop this year and then recuperation. I think that tractor sector, probably we will see good year even in 2020. Even in this difficult situation, we see the tractor business going up.
Okay.
And the two-wheeler drop that we saw in this quarter, yes, but we will see less. I would say half of the drop than the passenger vehicles, and two-wheeler probably will be one of the winners in the new era that we are going to live in the next years. With you know that this crisis will change how we will move, how we will see the communications and the transportation of the people around the world. So we will see a change in the paradigm, and in this sense, the two-wheeler will recuperate also. And finally, the truck vehicle, the information that we have is that this year, in 2020, we will see the drop. Next year, we will recuperate part of the drop. And until 2022, we will not see the truck market at the same level than 2019. So that's more or less the view. So we will see the recuperation in some sectors quite fast, and in other sectors it will take 1 or 2 years to come back to the normal situation.
Yeah. So just as a follow-up, since your customers are not going to produce that much, our top line and our sales will also not go up. So at lower sales, we have to achieve higher margins or higher EBITDA, and we are gearing for that.
Sorry, I didn't understood. Can you tell me?
Yeah, Mr. Jayesh Gandhi, BSLI, he's asking that our sales level will reduce in 2020. So at the reduced sales level, can we target higher margins?
Yes.
Hello?
Once I would say now the margins are affected because of the drop. This is normal effect. We are trying to minimize this effect. Once the market comes back, or at least we don't need to recuperate 100% of the market to come back to our normal margins. Okay, that is because we are adjusting also our fixed costs, and we are adjusting our internal costs, improving efficiency. So with some drop of the market, we will be able to recuperate the margins. That is the strategy.
Wonderful. Good to hear that. Thank you. I have more questions, but I will come back in the queue. Thank you.
Thank you, sir.
Thank you. The next question is on the line of Shyam Sundar Sriram from Sundaram Mutual Funds. Please go ahead.
Yeah, hi, Ander. Hi, team. Thanks for the opportunity. Ander, you will talk about employee benefits, grants coming from the government towards these payment of labor wages. So when we say the governments are ready to pay 60 to 80% of the labor cost, is it on the overall on the total labor wages, or are there any underlying conditions to it? If you can just help us understand. And how much benefits will be from a Mahindra CIE Europe perspective? How much can we expect during the quarter?
Okay, in the government, they have these schemes that you have to ask for and explain why you are asking for these 8 schemes. In this case, in India, in Italy, in Spain, and in Germany, we have applied for them, and we have been already granted, and we are already applying or receiving this support. Okay, so these amounts are approximately, as I mentioned before, they are 80% of the total cost in Italy, approximately 70 in Germany, and a little bit less in Spain. Okay, and the impact of this approximately is 4 million euros in the quarter, by quarter. That is the amount of the support from from the government, just as an approximate figure.
So 4 million for the entire quarter, Anders?
Yes. Yes.
Okay. Okay. So this is on a base of say 30 million euros kind of an employee cost.
It's based on, sorry?
No, so this 4 million, on an average, employee cost in Europe will be around 30 million per quarter?
Yes. Yes, can be, yes. Approximately, yes. We can check that, but yes.
Approximately. So then this 4 million is on the base of 30 million. So I'm just trying to understand, Ander. So when we say 80% of the labor wages will be borne by the government, this doesn't seem to be 80%, right? So I'm just trying to understand that, sir.
Yeah. Yes, 80% is in Italy, but no, the point is the 80% while they are stopped. Okay, and we don't expect our people to be stopped all the quarter. Okay, if we were stopped all the quarter, the amount would be much higher. Okay, that is the point. So you could consider that if we have, let's say, imagine that the sales goes down to zero in all the quarter, the amount that we would receive from the government would be something like, in average, I think more or less the 15 million euros. Okay, but as we plan to produce in May and in June, we only ask for that support when we have the plant idle.
Okay, understood, sir. So there's one more question. So even when we start also, we will be just an addendum to the same question. Even when we start, we may not be employing the entire labor, right? We may start with like 25% of the labor and then gradually we'll ramp up, isn't it?
Yes. And in fact, we are only applying this support system when we don't need to produce, okay? So, for example, I will give you the example. In April, one of the plants in Germany has been working more or less at one shift during all the month because we had certain orders to cover from our customers. So in that plant, we didn't ask for the whole month of support from the government. So we only ask for 2/3 of the amount.
Okay. Understood. So, one more question on the other expenses. So, how much of the other expenses can we consider it will be fixed costs and how once the plants start running, and how much will be variable?
We can say that in the global, at MCA level, our fixed cost per month, including both salaries and also the normal cost and without the stock, could be at about 1,000 million INR per month. That's our fixed cost per month, more or less.
Sorry, sir, how much? 100 crores. For MCA console, including employee costs, you're saying 100 crores per month, is it?
That's it.
But on a consolidated level, yes.
Yeah, at the consolidated. Okay, so this is a fixed cost. When the balance
all fixed costs, including labor.
Right. Yes. And other factory overheads also included. Hello?
Yeah, carry on.
Other factory heads are also included in this when the plants are running, sir?
Yes. All the factories included there, yeah.
Okay, understood. So, one last question. Because of the COVID guidelines being put in place in our factories, is there any increased cost of operations? Are you foreseeing any incremental cost because of these new guidelines being put in place?
We think that we will have some incremental costs, maybe coming from additional cleaning services and probably less efficiency, especially in the beginning. But in the midterm, once we train everybody and we optimize these processes, I think that the cost increase coming from these measures will be marginal. So we don't expect impact. I would say that in Europe, the impact is or will be close to zero. In India, can be a little bit higher due to the amount of people that we have, so we need to keep distances and increase certain cleaning procedures in the plants. But overall, I think for Mahindra CIE, once we have implemented properly the measures, we are not counting on impact. Perhaps some marginal in India.
Okay, understood. And lastly, on the capex for CY20, any guidance will you have planned for it, please?
Okay, for the capex, what we have continued our committed capex that we planned to or we launched in 2019 or beginning 2020. So we continue with that plan. What we are now is we have cut it. Let's say we have cut the new investments that are not essential for the customers and the production. So we postpone some of the capex. But let's say I see that once the market comes back, we will restart the programs. So we will more or less expect the same capex than the previous year. That is until now we are in 900 million rupees. This is the capex we have had in the first quarter. So we expect to keep the capex plan and eliminate only or postpone the non-necessary one.
So, sorry, for the full year, how much capex you mentioned under? Sorry, I didn't get the number.
In the first quarter, we made 900 million rupees. But all these capex is programmed or planned and committed by previous during 2019. That's why we continue with these plans.
Okay. And for the full year, CY20?
Okay, we need to check that. I have not that figure now in mind.
Okay.
We need to review the.
Sham, we'll have to review that.
I'll take it off. No problem.
No, it's not a matter of offline. What we are saying is that we will review the capex situation if the market comes back. If the market comes back and all the customer-related commitments on capex that we have made, we will do. But it is subject to the market coming back. That's the reason why it is difficult for us to give a number. But during this period, whatever is not required to keep the customer requirements going, we are either cutting it or postponing it. So we really don't know how much that capex would be. Whether it would be 19 to 4 or 19 to 2, we don't know as of now.
Okay, understood. Thank you. Thanks, Vikas. Thank you.
Yeah, okay.
Thank you. The next question is from the line of Amin Irani from CLSA. Please go ahead.
Yes, hi. Thanks for the opportunity. I don't know if this question has been answered earlier or there was some disturbance on the line, but with regards to India, obviously we do not have any wage reimbursement program by the government. But I just want to understand what will be your mix of contract and permanent workforce, and in that context, what are your thought process of your payments to contract workers, say during the time of the lockdown? I understand that in March and in April we would have paid everybody, as per my understanding. But say if the lockdown were to continue or it were to come back again, and when the production ramp up is very slow, how does the difference between the permanent employee and the contract employee work in terms of the wage payment?
Okay. During the months of March and May, we have kept all our permanent and contract workers, and we have paid them 100% of their salaries. Okay, this is the suggestion from the government, and we we help and or we try to keep our workers because we value them and we think that we will need them for the near future. So I think this is a strategy from our company to keep our workers, protect them, and try to survive to this pandemic properly. Then our ratio of contract workers it's different from one division to another, but we can consider between 30 to 40% of our workers contract workers, and we, depending on the future and in the market, we could see a reduction in the future. But right now we are trying to keep them, and until we don't see the real evolution of the market, we are not making any decision. So that is what we agreed in the board of the company, and that's what we are applying in the board.
Okay, understood. That's helpful. I'll join with 2 more questions.
Thank you.
Thank you.
The next question is from the line of Rajikumar Vaidyanathan, who is an individual investor. Please go ahead.
Yeah, good evening. Thanks for the opportunity. So I have a couple of questions. The first one is on the when I looked at the consolidated results, I see that there is a 45 crore exchange loss booked during the quarter. I understand this is a loan which the Mexican subsidiary has taken from the group company. So just wanted to know, it's a huge hit to the P&L. So just wanted to know what is the reason we have not hedged the effects there?
Mm-hmm. Okay. This effect has been because we have a $26 million loan in our subsidiary in Mexico, BF Mexico, and the peso, the Mexican currency has had a huge depreciation in the last quarter. The impact of this exchange rate currency depreciation has been of, as you said, something like 42, 43 crores. What we are now planning for the next quarter is we will change the functional currency to the US dollar, because in Mexico all our sales are done in US dollars. Okay, so we have the sales. I mean, all our customers are invoicing us in US dollar, and the raw materials we buy in US dollars. So let's say most of the costs and let's say the P&L is based on US dollar. That means that we will use the dollar as the functional currency. So we will avoid this kind of effects in the future, and we will recuperate in the next quarter this impact.
As well, all of our collections in BF Mexico are in US dollars. We cannot make any kind of hedge for this loan, because as we were collecting, we were paying the loan also with the US dollars. That's the reason of not making any kind of hedge.
Yes.
Okay. With the functional currency to US dollars, we will avoid this kind of, let's say, kind of artificial exchange rate fluctuation. Yes.
Okay. Okay, that's a substantial impact. I think the peso depreciated almost 20% this quarter. So, given this kind of a currency, I was just wondering, from a risk management standpoint, I was wondering why the company has not hedged the FX part of the loan.
Yeah.
That's the reason. Our collections are in dollars.
Yes.
We use that cash to repay the loan. So.
Yes.
Okay. The second question is, I think in the introductory remarks, I heard that one of the group company has been purchasing shares of MCI India. Last quarter, I saw it in the insider trading information as well. So just wanted to know. I mean, it's more like a token purchase that is done. So just wanted to know, whether that is continuing, because we are not after the 31st of March. So
No, of course, our trading window was closed till tomorrow. I think the trading window for us will open only after the results. So that we certainly, CIE certainly could have bought more, but our trading window closed on Thursday.
Yeah. Okay, sir. Thank you.
And CIE is willing and able to buy more if required. Yes.
Sir, if you permit me to ask one more question. So I just, if I understand correctly, the debt to equity ratio is about somewhere in the region of 1:4 for the company. So just wanted to know, have you done any kind of a stress test, in the worst case scenario of the lockdown is to get extended by, say, another quarter or so? Just wanted to know what would be the pessimistic view of the debt moving. If we have any kind of a ballpark number, whether it will move from the current 1:4 to where?
We have not done any, let's say, any forecast on that scenario because the uncertainty is so high that it's difficult to make any calculation right now, depending because everything will depend on the evolution of the market. So the main message in this case regarding the debt is that our debt level is very low in this moment. Compared to EBITDA is 1.5 or approximately 1.5 times EBITDA, and the cash situation of the company is very, very solid. We have been managing that with the available cash and with the available credit lines. We can survive and we can keep the company running normally in the next 6 months. Okay, so the situation is very solid. Even in Europe, the situation is solid, and we have the support of our mother company, let's say CIE. So globally the debt situation is under control, and it is not a problem for us in this moment. We are focusing our efforts right now on the efficiency and preparing the company to the let's say to restart properly the production.
Okay, thank you, sir.
Thank you.
Thank you.
Thank you. The next question is from the line of Nitin Shakir from Green Capital. Please go ahead.
Hi, good afternoon to the management. I have two questions. My first question pertains to the loan provision of
the break-even level. So approximately it's at 70% of the standard we can survive.
This would be for both India and Europe.
Yes, this is for both India and Europe. Yes.
Okay. Second question pertains to the organic decline in 1Q at India and consolidated level, if you have that number.
Okay. Yes.
Jinesh, what is the question?
Generally, X of AEL, what would be the decline in India and consolidated revenues?
Yes, without XAL in India, the drop would be 30% approximately Q on Q, and in Europe, as you saw, it's also this 30%. So we would be at 30% drop in Mahindra CIE XAL.
Okay, this is compared to same quarter last year.
Yes.
Right?
Yes.
Okay. And last question on
that same quarter last year was a very good quarter, if you recollect.
True. Obviously, that was near the best quarter of last year. So, yeah. And last question pertains to for the European operation. What would be the revenue decline in euro terms, given that there has been also benefit of INR depreciation?
Vikas, can you help us with the question?
So he's asking, Jinesh is asking, in euro terms, how much did the European business decline Q1 T19 to Q1 T20 in euro terms without the exchange rate?
More or less the same. There has not been any relevant change on the exchange rate.
No, it's 33%.
33%.
Yes.
The exchange rate difference has been peanuts, very negligible.
So no difference.
No difference in the foreign exchange rate.
Got it. Okay, great. Thanks. All the best.
Thanks, Dinesh. Yes.
Thank you. The next question is from the line of Vivek Kumar from Shivsagar Investments. Please go ahead.
Thanks for the opportunity. So I just want to know, in forging technology, I think Mahindra CIE will be the major arm for the group CIE. And what is the potential for the next 5-10 years in the forging technology with respect to the revenue?
Vivek, so you are essentially asking, is Mahindra CIE important for CIE?
What is the role of Mahindra CIE with respect to the total group, the whole group of CIE? Where is its position with respect to the different technologies? Yeah.
So, no, we have always said that Mahindra CIE is CIE's arm in India and Southeast Asia. So anything that CIE does in any technology in India or Southeast Asia will be through Mahindra CIE. And Mahindra CIE is also the global arm for CIE in the forging business. Okay, so anything that CIE does further in forging will happen through Mahindra CIE. So this is what Mahindra CIE's relation vis-a-vis CIE is. So that's one. And then your second question was really, where do we see forging technology going?
And how big is the opportunity size? Yeah.
Look, forging technology is perhaps the oldest technology known to humankind. If you look at it, it's from the questions will be asked with respect to electric vehicles and so on. If electric vehicle comes, there will be a little bit of decline, no doubt. But given all these social distancing and other things that are coming up, I think there will be some pause on whatever is happening on electric vehicles. So we continue to see IC engines playing a big role. Of course, IC engines will remain in trucks and tractors and some of those things. So to that extent, forging will remain a very important part. Now, what exactly will happen in 10 years' time, we have not taken a call.
We are like 5,000 crore revenue in forging. I think it is around 4,000-5,000. So, how are the competitors doing? Is it possible for a 10,000 crore revenue from just for forging in the next 5-10 years in the group?
Yeah, of course it is possible. Of course it is possible. You have Bharat Forge before us, before you, the kind of revenues they have. So it is possible. So there is enough growth opportunities in forging. In fact, we see in the near term there will be greater opportunities in this area as OEMs focus more and more on designing, developing new technologies, new cars. There's a whole lot of changes happening in the auto industry. So there will be less focus for OEMs on the tier 1 technologies like engines and so on and so forth. And companies like us will have greater opportunities in the medium term at least. So we do foresee opportunities coming our way in the medium term.
And with respect to different technologies for die casting, aluminum die casting or roofing or this composite, if you buy a company in India and that has a factory in suppose in US or Europe, then how do we align that? Suppose we are.
We'll see when it comes to it. We'll see when it comes to that. Of course, our first preference is to expand in India, as Andrew pointed out, because CIE attaches great importance to the Indian market. We'll come to it when if we have an M&A opportunity in which there is an adjunct plant in Europe or US. We'll have a look at that at that point.
We have a cost benefit with different technology, like for die casting, aluminum die casting, or any other advantage India, then we can make that revenue.
No. What is the question?
Like if we have cost advantage in India with respect to different technologies, and then we can make it an Indian hub for CIE Group? Is it possible?
Look, at the end of the day, within the CIE system, CIE is a very efficient company worldwide, as you are aware. CIE makes very high margins all over the world, not just in India or Europe. So wherever there is an opportunity for exports from India, we will definitely look at that. But it's not true that CIE entities in Europe make less margins or lower margins than the Indian entities. In fact, large number of them make higher margins than the NCIE plants in India. So it depends. And if there is an opportunity, we'll surely look at it.
And today the CIE, the portion is around, Mahindra CIE portion is around 25% of the total group, I think, the turnover.
No. On a consolidated level basis, I think M&M will be, anywhere between 10 to 15% on a consolidated basis. On an India basis, they will be anywhere somewhere around 33% for the India revenues and less than 15% for the consolidated revenues.
It is only 10.
Around 15%, you might say. So because India is roughly about 50% of the consolidated revenue, and they are 30 to 33% of India revenue.
We are having 1,000 crore revenue in Mahindra CIE consolidated.
Yes.
And the group, the total CIE revenue is, I think, $2 billion. So 2 billion or.
Alright, what is the overall CIE revenues in C19? Is that revealed or we are still waiting for the board meeting, I guess?
No.
So we can talk about
Last year? What was it last year?
Yeah, but just if you make a forecast of the figure, we cannot disclose, but it's if you can say 3.5 billion. This is so it's approximately. Mahindra CIE is 25% of global CIE.
Yeah, 25% of the global CIE.
Yes.
Okay. So is this going to change or something like this? Can we see that in next 5-10 years?
That, as I said, India is an important focus area for CIE, but it depends on how the market grows. So it really depends on how the market.
Okay. Thank you.
But India remains a focus area for CIE.
Yes, absolutely.
Thank you. The next question is from Ujjwal Shah from Quest Investment. Please go ahead.
Yeah, thank you for taking a question. Just wanted to know the performance of Bilforge and AEL during last quarter and what kind of margins did they achieve?
Okay, both AEL and Bilforge has performed better than the rest of the divisions in India, mainly because they are more focused on two-wheelers and exports. And the drop has been a little bit less than the rest of the divisions of Mahindra CIE in India. Okay, the margins in AEL, you know that when last year we were about 12% of EBITDA, and that's the range where we are now getting 12-13%. This is the EBITDA margin level in AEL. And Bilforge has a good year last 2019, and we were improving, especially because the problems in our Mexican plant were solved, and we were improving the margins. EBITDA margins in Bilforge are around 18%, and in this quarter, due to the drop of the market in the last month of the quarter in March, we had some reduction on that margins. But our standard margins are 12 in AEL and 18% in Bilforge.
Great, thanks, Andrew. And also wanted to know on the European business and our CV side business. during best of the times, when CV business was booming, when the growth was very strong, both from Europe as well as the US side. So even during that time, the CV margins were around 8% at best. So what is the long-term strategy that CIE has for that CV business? Because the rest of the business in Germany is making wonderful margins, and the CV side, because of perennial problems, having plants in Germany, whatever be the reasons, and during the best of the times, the margins haven't been good. Are we seeing a long-term strategy to hold on to the CV business as we see margins improving there, or at some opportune time we might think of selling it off?
Okay. We, as you mentioned, and our CV forgings margins are the worst margins that we have in Mahindra CIE, especially in our forgings in Germany. However, we continue working to turn around this business and to make them at least at the profit level that we can survive in the long term. Okay, so our strategy in this period was to reduce the size slowly of this business and controlled downsizing of this business, because they are not giving us the proper profitability, and at the same time continue with the restructuring activities to increase the performance. I think that our businesses in Germany right now are improving, and we will be able to keep them in Mahindra CIE, perhaps with some downsizing and consolidation in the future. But our aim and our strategy is to make them profitable and to have a long-term business, even if it is not as big as it is now, but with a smaller business with a little bit higher margins than current ones. That's the strategy.
Great. Thank you, Andy, so much.
Thank you. The next question is from the line of Priyaranjan from Antique Stock Broking. Please go ahead.
Thanks for taking my questions. Just two things. One is on, have you heard anything from your OEM side, particularly on their capex reduction, particularly on the product development or the new programs, etc., where you might be associating with your OEM partners? And second part is on the cost side. So if suppose I was purchasing 100 ton of say steel and if my volume has become like 70 or 60, so will the steel price drop will help me, or my prices might go up because we might have contracted for a little longer?
Okay. Can you help me with the second question?
So the first question is, are OEMs reducing capex, and will that affect our programs? The second is on the cost side. The question is, steel prices are going down, but are we contracted with our steel suppliers so that we will not benefit from any reduction in steel prices going forward, because we have been contracted for a longer period?
Yeah. No. Okay. Regarding the OEM's capex, we have not yet any information from them that they are cutting capex or development. No, we don't have that information yet. Okay. We don't know if they are going to disclose anything in the near term, but till now, let's say that we continue the programs that we are developing with them with no stop. Okay, so till now there is no more movement on that. And regarding the cost of the steel, let's say that we have our contracts and commitments are short-term commitments, And no, we are not squeezed on that. We manage this. We negotiate with our customers, and we negotiate with the steel suppliers, and we find the agreements. No, there is no risk on that.
Okay. But I mean, is it? I mean, the prices of steel, etc., is also linked to the volume. I mean,
not really. No. Of course, we agreed with the steel mills the prices on certain volumes, but there is a flexibility on that, and we can balance between we are not working only with one steel mill, so we can decide the strategy. So as our customer does with all of their suppliers, we balance the supply from different sources, and we decide the strategy each time. So we don't expect to have a burden or a loss due to that. Not at all.
Okay. And lastly, on the working capital side, so I mean, I have been hearing mixed trends from the OEM side. Some OEMs are actually extending the credit period. Some OEMs are shortening the credit period to help the suppliers. So I mean, what are you witnessing? I mean, between different, I mean, say India or Europe, or between customers, major customers? How do you see that?
Not yet. We have had certain delays, in fact, in the payment in some customers, but then they are recuperating, and let's say the payment terms continues in the same situation. No changes on that.
Small delays,
but not relevant. No, and we decided also as a company, as we are in a strong or relatively comfortable position, we are paying on time to all our suppliers. I mean, this is the decision to support also to our supply base.
Okay. Thank you. I mean, wish you all the luck. And thank you. Thanks, President.
Thank you very much. Thank you.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
No, thank you very much. Thank you very much for listening to us patiently. Please rest assured that we are working very hard, and we are very optimistic, and we are very confident that we will deal with this crisis in a good manner. And yes, Andrew, your certificate.
No, that's my comment is the same. Is to reinforce that despite the situation is difficult for everybody in terms of the health of the citizens in the different countries we are located. Regarding the business, we need to have an optimistic view, and I think that the market will come back. Perhaps it will take 1, 2, 3 quarters to come back, but we are prepared. We are in a solid financial position. We are doing our job. We are completely focused, and I think that we will emerge stronger than before. So that's the point, and thank you to everybody.
Thank you very much. On behalf of ICICI Securities, that concludes the conference. Thank you for joining us.
Thank you. Thank you. Thank you. Have a good day, guys. Bye.
Thank you.
Thank you. You may now disconnect your lines.